welcome to NDTV Profit. You're watching the Portfolio Manager, and my guest today is Anand Shah, who is the head of PMS and AIF at ICICI Prudential AMC. He manages asset under management of over 19,000 crores. And to talk about his AUM and his portfolio, and how he's broken up the portfolio with a major exposure to manufacturing. He's joining us today. Anand, thank you very much for joining us on NDTV Profit, the portfolio manager. One of the key themes that easily comes out from your portfolio is the exposure to manufacturing sector. And I've been looking at some of the three major schemes funds that you have, and each of them have more than 50% exposure to manufacturing or allied manufacturing. Give me a sense of why you have gone so bullish on manufacturing.
Yeah, firstly, Sajeet, thank you so much for having me here. And so just to give you a little bit of context of the manufacturing and manufacturing allied, which interchangeably we'll also use as B2B businesses. If you see the history, so last decade, at least 2010 to 2020, was a forgettable decade in the sense that a lot of things that could have gone wrong had gone wrong. We had a global financial crisis in 2007. Obviously, we continued to do capex, but then all of a sudden the capex cycle just not only in India, globally also, but more importantly for India, the capex cycle just took a downturn for almost a decade between 2010 and 2020. I think more importantly, that was the decade also in which China was relentless. I think China added capacity in manufacturing across the board. So from safety pin to boilers, from tires to tiles, whatever you need, China had capacities to deliver to the rest of the world. So it in a way, had become a factory. What it did in that decade is it exported deflation to the world. Means the manufactured goods didn't become very expensive. They remained soft. Prices remained soft, which is negative for the profitability of the manufacturing industry. And lastly, bottom-up or almost stock-specific companies had done very good capex on the back of 2003 to 2007 capex cycle that we had. That continued all the way up to 2010. But that was the era which many of us would not remember today. But in 2007, there was like the word FOMO as we use. There was a fear of missing out doing a capex in this country. So that was the era when a lot of these companies did very well. So combination of factors came together, leverage on the Indian balance sheet, and obviously subsequently there was NPA cycle in the banking system also. I'll come to how select financials will also benefit from manufacturing and manufacturing allied recovery. But I think when I put all these factors together, what has changed in last 3 years? I think not only last few years, there was a change of regime both in China and India. So there was a change of regime in China which said quality of GDP more important than quantity of GDP. So they've been more focusing on pollution control, decarbonization of their economy. Obviously, their labor costs started going up as their working age population started diminishing over time. And most importantly, the regime change also meant that the export incentives which are available for exporting manufactured goods also kept on diminishing over time. In India, we had a regime change where there is a significant focus now on manufacturing, to revive manufacturing in this country, Make in India, Atmanirbhar, PLI. So I think combination of factors coming together, which we believe will revive in a nutshell over next decade, some bit of manufacturing, and obviously the manufacturing allied businesses like utilities and others will also benefit.
If I look at your investment themes, there are 4 or 5 in all. One is the rising energy intensity, then there is increasing urbanization, government capex on strategic sector, financialization of a sturdy digital backbone, and experiential consumption. Now,
Sure.
if I look at rising energy intensity, you're looking at basically construction, real estate, FMEG, which is fast-moving electrical goods, and job creation. Can you give us an idea of how you are allocating within manufacturing these sectors, and where do you see maximum potential coming in?
So when it comes to portfolio construction, Sajid, we are more bottom up. So while we might really like defense sector today, because the growth prospects are great, but with the bottom up, the stocks might not be cheap anymore. So given that on the overall theme of manufacturing and manufacturing allied, there are subsegments where we believe structurally things looks very good. One of them being energy intensity. I think India is underinvested in power for a very long period of time because we had, in a way, a surplus. So I think time has come that country as a whole will have to invest in increasing capacities in power generation, power distribution, and transmission, and all three areas we like businesses there. On the select manufacturing, yes, railways is there, there's defense. Again, the stocks might not be very cheap, but we will be able to find second level beneficiaries for the same, which we are looking at. I think metals is very interestingly poised within the overall manufacturing because India has a right to win. We have raw material. We remain competitive even in the worst of the times, and as now the rest of the world decarbonizes. So while India will also decarbonize its metal manufacturing, but will be the last. We already seeing US, Europe, and more recently Japan, Korea, and also China investing or at least committing investments for decarbonization of their steel manufacturing, to some extent aluminum manufacturing. It's overall a very good news given that will keep the prices of the metals elevated. That's also positive for the metal manufacturing.
Another interesting thing from your portfolio that comes out is the financial services. You have a decent amount of weightage there, but it's much lower than the manufacturing one. In the last 2.5 years, we have seen a lot of fund managers going heavy on financial services. What is your view on that segment?
So all in all, we remain constructive. I think what this real estate industry faced as a challenge in the last cycle was a very rapid rise in the prices. I think that is something one will have to keep an eye on because while incomes have caught up with the real estate prices, but they still remain fairly expensive in most of the large cities. And to that extent, any spike in the real estate price then will bring down the demand and will create the volume issues for many of these companies. So I think I agree with you. They've done extremely well in last year, and we've sort of benefited, but we've been still closely watching it. That space has post RERA again. There will be consolidation in the industry from unorganized to organized. So there are reasons to believe that they can do well as long as the real estate prices remain well.
And the kind of pre-sales which we are seeing from some of the top 10 or 12 companies, do you see that that's translating into revenues and profitability much faster in the next 3 to 4 years as compared to in the previous cycle where they got stuck in the debt trap?
Indeed, I think these all pre-sales should help in terms of cash flows with a lag, in terms of profitability. I think we were also initially worried with all the pre-sales numbers that we're going through and the quantum of real estate. A lot of these companies were able to sell in a very short period of time. So we sort of did a little more research and tried to see whether this is more of an investor activity. But what feedback we are getting from ground is, I think there's also a pent-up demand, as I was saying, the end user, as well as there would be some investor also who would be taking a view on the real estate prices in times to come. So far so good. I think definitely I agree with you that this pre-sale should eventually help in terms of lower debt, higher cash flow generation. The trick would be to keep on, enough supply into the market and keep the prices low, and that would be a good news for the overall real estate.
Anand, we need to slip into a short break. When we come back, we'll discuss your pipe portfolio, which is of mid cap and small cap, and how you're structuring that portfolio. Stay tuned to the portfolio manager. Welcome back. You're watching NDTV Profit, and this is the portfolio manager. And with me is Anand Shah, who manages over 19,000 crores in assets across PMS and AIF for ICICI Prudential AMC. Anand, I want to look at your pipe. Strategy. It's basically of small and mid cap companies. How are you looking at this particular asset class? And we've seen a lot of run up in small and mid cap in the last 18 months. How do you structure this portfolio from here on? Because many of them are at a very high valuation today.
So let me take a little step back and explain to you the product. So this product is meant for long-term investors where they're looking for investing in a very deep value businesses or a very high growth businesses. What we are suggesting here, the full form of piping, private investment in a public equity or private style of investing in the public equities. We are saying if you have a decent time horizon of 5 years to 10 years, there are opportunities in the market where they might be mispriced or the growth might be mispriced, they'll be reasonably priced. And in that context, what we are building a portfolio of companies which can become from small cap to mid cap or from mid cap to large cap. So here, if you see, we are not looking for incremental growth, we're looking for at least from our at the point of investment, we are looking for a company which can scale into the next stage from small cap to mid cap or a mid cap to large cap. So that's the overall product. Frankly, though, that worked very well in last 3 years for us. We're continuously looking for businesses. Again, if you see here, in the small and mid cap, the weights in the manufacturing allied actually has gone up further. And the good news is that when I divide the entire composition of the index, large cap has very little manufacturing and manufacturing allied. It's dominated by IT services, banking, financial services, or consumer-facing businesses. There's very little manufacturing left there. A lot of manufacturing and manufacturing-allied businesses over a 10-year when it underperformed now sits between mid-cap and small-cap. So I think if you really want to play manufacturing and manufacturing-allied in its purest form, the small and the mid-cap portfolio actually offers you a much more opportunity than the large cap.
I can see some of the top holdings. You have some of the power companies which is there, like Sharda Energy or Godavari Power, and you have some of the mid-cap banks as well, or small finance banks, Equitas or Indian Bank, for that matter, or Karur Vyasya Bank, or Repco Home Finance. So there is a mid-cap thing, but my question is about the valuation for these companies. Do you still hold on to higher valuation given the fact that there is potential to go to the next level for these companies?
So again, it's a myth again that all the small caps are expensive. So again, it's a very wide basket. I agree. There are pockets of small cap and mid caps which are really expensive, and same applies to the large caps also. That there's a pocket of large caps very expensive. As I was discussing before, I think mid cap, particularly mid cap and small cap, and within that the manufacturing allied businesses, select financial companies, actually were fairly priced, or maybe underpriced 3 years back, given that segment of the market didn't do well. And even today, 3 years later, as we track the earnings growth rate in our portfolio, actually the earnings growth rate is much faster than even the price growth rate. So while the portfolios have done well, the valuations of this portfolio are actually not skyrocketing. So yes, it will be a lot of bottom-up stock picking. I am cognizant, and we as an organization are very cognizant of the rich valuations in the select small cap and mid cap businesses, and we're sort of trying to avoid that. But otherwise, at the portfolio level, our portfolio, as we see, and from a price to book perspective, from price to earnings perspective, we continually keep an eye that we should not be paying too much for the growth. Generally, also not only small and mid cap, but even in the large cap.
How do you look at consumption as a theme, and because consumer is a very small segment of yours, 12% or so, and services also, which is 2.8%, which is there. So how do you look at consumption as a theme? Do you see consumption being the theme maybe going forward as things revive from on a ground level?
So in India, the consumption is evergreen. I think we have 1.4 billion population with a rising per capita income. I don't think consumption is going to be in a recession as such. I think, but there is a difference between owning a good business and owning a good investment. I think very early in 2020, 2021, we took a call that while consumption in India can continue to do well, because of the last decade when only consumption stocks did well, or consumption companies did well, there was a severe mispricing in the consumer stocks. I think that was an important call we took, which has played out for us. Is we have avoided many of these very frothy, very highly priced consumer-facing businesses, given that while they will continue to grow, but there is other segment of the market which has not done well for a decade, and that's actually now growing much faster than the consumer business.
And how do you manage IT and IT services, because that used to be the darling of the market a couple of years back, till we saw some kind of demand issues coming in there. In your portfolio, it's a very minor portfolio stake which is there in IT companies. I think 2.8% in the pipe strategy, and in the contra fund I don't see it. So how do you look at IT?
So indeed, this is again the right question. So we have a BMV philosophy where all the three are important. We call it business, management, and valuation. So to be very honest, the consumer-facing businesses and the IT businesses in India, IT services business in India, the business is good, the management is very good, the valuations was an issue when we actually went underweight in IT services in late 2021, early 2022, when we went underweight. There was a mispricing. Why was there mispricing? Because in 2020, the first year when we were hit by COVID, and even the calendar year 2021, when we had a second wave, I think this sector did extremely well because globally businesses were focusing on IT spending, given that they didn't have much more spending to do on the office space or employees. Travel was not there. And people extrapolated that growth into next many years. I think what the call our team took was this was one-off. The growth that IT industry saw in 2020, 2021 was one-off and not sustainable, and that worked out. So what has happened in the subsequent 20 years, the growth has slowed down. The industry continues to still grow, but it's just that it's slowed down, and the reality is dawned on many of these investors while they're blaming everything else. To me personally, they have reverted to the mean. I think industry continues to remain solid and will grow well. There will be a point of time when the valuations become reasonable and the same sector will be worth it.
Finally, Anand, manufacturing and you're betting on domestic growth there. Are there any international headwinds that can disrupt the portfolio in any way, especially manufacturing segment?
I think there are two headwinds. One can be a potential headwinds would be obviously energy prices. The Indian domestic growth is significantly dependent on the global energy prices, given we import most of our energy, whether it is oil and gas, or even partly on the coal side also. So any spike in the energy prices is a headwind generally for the economy, and it will apply for the manufacturing. The other one is obviously what we've been seeing for last 24 months is the destocking cycle that's gone through both in US and Europe. So any slowdown in the developed world will have indirect, might not have a direct impact, but will have indirect impact on the Indian manufacturing sector. We have seen select sectors actually seen, like textiles, have seen significant slowdown. Even in, for that matter, the metals have seen some bit of slowdown in demand and pricing as US and Europe have been destocking post the restocking cycle they had in 2021, 2022. So yes, that's another headwind. Any slowdown in the developed world, the interest rates have risen, can be another headwind for the sector.
Anand, it was a pleasure talking to you today. Thank you for joining us on the Portfolio Manager. That was Anand Shah, who heads the PMS and AF for ICICI Prudential AMC, managing over 19,000 crores in assets and talking to us on the Portfolio Manager. Thank you for watching NDTV Profit.